Good morning.
Morning.
Good morning. All right, so we got some heavy number crunching today, and at like 7:55, I started teaching at 8, and at 7:55 this morning, my second grandchild was born. So
our last position. Yay!
oh, it was. Remember, this is one in Los Angeles that has COVID, and she has pneumonia, and they sent her home. So she's been recuperating at home, but she started having problems with her liver because of, quite don't understand yet whether it's the medication from the COVID or COVID itself, but she started having liver problems with her liver. Don't think it's permanent. So they put her back in the hospital yesterday, and then last night they induced labor because she's still not due for another month. So she's been laboring on Pitocin, which is the drug that they give you to induce labor, and it's not fun labor, with pneumonia. So she's been laboring, but anyway, she labored starting yesterday afternoon and finally gave birth at 7:55 our time this morning. Of course, she's in California. So I have a new granddaughter, and she's healthy, and I hope that Maria ends up healthy because it's been quite something else. But anyway, got another granddaughter. Sadie is her name. And so had that going on this morning. But we're going to focus on accounting and capitalized interest. So the first thing that I would like for you to do is bring up the sheet. Can more of y'all put your faces on? Y'all just don't know how much it really means to me. Paula, I miss you. I hadn't seen you in a while. Miss Wynn, how are you doing?
Good, how are you?
I'm doing excited, relieved. It has been quite the evening. Maya, thanks for joining me. David usually does. Anna, Dom, I haven't seen you in a while. Dom? Oh, yay, yay. Danielle, getting pictures. It just means so, it really just means a lot to me seeing your faces, and then I can react. And I don't care what you look like. Don't care at all. Paula, how are you doing? There she is.
Hi, good, thank you. How are you?
Fine. Look, we all got messed up hair. When's the last time any of us had haircuts? Oh my God, it's wild. Just so what?
Yeah, I need to get my hair dyed again, but
it's just crazy. And then especially, I'm so glad that I owned my gray and instead of quit dyeing it, because I've seen so many ladies, the couple of times I've gone into the grocery store with roots, and oh well. Brett, how are you doing? Are you gonna let me see you?
I'm doing good.
Good. Where'd he go? He went somewhere. Alec is there. There's Brett. Dom. All right. Danielle T. Cool. All right. So what I want you to do is I want you to bring up the, the notes page where I'd summarize chapter 10 for you. And then you're also going to need the decision tree. You're also going to need the decision tree that I have given you. Before we get into the number crunching, the topic that we need to cover before we get into capitalized interest is on the second page. On the second page of the notes was ways to finance long-term assets. And we're going to need to spend some time. We'll talk about all of them, but the only one we need to spend time number crunching is the non-interest bearing notes. You read about them and hopefully practiced on page 527. Look at all the faces I'm getting to see now. Thank y'all so much. Jordan, you gonna join us? And Nelson. and Sean, and Edris. I saw Edris earlier, then he went away. There he, thank y'all so much. There's Sean. Thank y'all so much. I just miss y'all's faces. So non-interest bearing notes on page 527. On page 527. I want you to work a problem, and you can see that in the notes I have described under the non-interest bearing notes what has to be done. I've given you detailed information about the non-interest bearing notes, and I want you to work exercise, I think it was 10.7, but let me double check. From my first class, I've got pages everywhere. Yes, work, it's not 10.7, it's 10.9. I want you to work exercise 10.9. So be working on exercise 10.9 by yourselves from having read it and from the information that I've given you. Right now, what I want you to do is to do requirement number 1, which is record the journal entry. Requirements number 2 and 3, we will do together. So do requirement number 1 on page 554. Okay, and I'm gonna go heat up my coffee and go to the restroom, and I'll be back 2 seconds because I've been teaching. So work the problem, follow the instructions that I've given you. Yeah, how's John doing? Okay, so how are y'all doing? And yeah, hopefully y'all are asking each other. Don't forget, this is like class where you could work together. Maya, you got it done or just reading?
Just reading.
Okay. And I'm not going to share my screen. I'm going to go into my Excel sheet.
Hey, Professor,
Yes.
I have a question in regards to ASC Project 2. I saw your announcement on Blackboard that it was due today at 7 p.m., but I was looking at the syllabus and it said it's due on the 30th. So when I do like my schedule for the week, I look at the syllabus.
Okay.
So I just want to confirm that it's still due today.
I can make it due on the 30th. I was trying to get some things off of the end of the semester for you, but due on the 30th, since that was on the syllabus, is fine with me if it's, jammed you up. I was
I
trying
mean,
to.
even if it's like Thursday the 23rd, like I just wasn't aware that it was due today.
Oh, I got it. Because it wasn't on the syllabus that way. I understand.
Right.
Yeah, I can move it to, how about, I don't even know when the 30th is.
That's next Thursday.
Okay, how about Friday at 7 o'clock?
Perfect.
Okay. Does that help everybody? Because I'm sure that y'all didn't do it. Some may have, but yeah, so I'll make it Friday at 7.
It's actually kind of hard. I found it harder than the last one.
It should be harder than the last one because you're actually having to do research into the answer, but it shouldn't be too difficult. I did it on topics that you should be able to locate.
Mhm.
So were you able to locate the topics?
Yeah, I'm just struggling with the last two questions, but I found like answers that support it. It's like not really like explicitly stated. So it's kind of like,
Okay,
or at least
why don't we focus on chapter 10 in class? And what I will do is I will put an announcement out that I will hold an hour of open office hours specifically about the ASC. And probably tomorrow. Is that okay? That work?
Yes.
Okay.
Mhm.
And I will do that for both the classes. And I'll just have open office hours about the ASC and we can focus on.
So I submitted it like over the weekend, like expecting it to be due today. But if
Yeah,
I want to adjust it, like I think I'm
yes,
good,
you
but if
can-
I want to adjust it, I can resend it by Friday.
yeah, there are unlimited attempts and
Okay.
it only shows me your last attempt.
Okay, cool.
Okay, so what did you get as the journal entry? What did you have to do in order to calculate the journal entry?
You have to find the present value of the note.
Exactly. So this is on page 527. So good. I didn't see, I think that was David recognizing the voice. So you have to calculate the present value of the note. Okay. I'm not gonna, I'm gonna kind of be a little bit fussing at y'all. We're towards the end of the semester and y'all have got to read these chapters. And like this problem that's on page 527, you should have had your calculator in your hand and calculating and critically reading the chapter. I've talked about it all semester long because it really slows us down in class. And, I just want to continue on because we've got a lot to do that's much harder than this, but we spend too much time in class doing this. So what did you calculate as the present value?
18,783.
Good, 18,783. When you look at the journal entry on page 527 to calculate what amount would I capitalize for the cost of the long-term asset, you see that I'm going to put notes on the board. I haven't done that in a while, but you see that you credit notes payable, and the amount that notes payable is credited for is the face value of the note. The face value of the note. Then you see this account that's called discount on notes payable. Okay, discount on notes payable. Before I write about the discount on notes payable, let's talk about it. Okay, let's talk about it. A non-interest bearing note. Is this note really non-interest bearing?
No.
Maya's shaking her head. I see Sean shaking his head. No, right? It is not really non-interest bearing. It simply means that it has a 0% stated rate. You think about that commercial. I know we've all seen the commercial on television where you'll have an automobile dealership and they're saying, come on, we're having this great sale and you can finance your car for 4 years at a 0% interest rate. Now, how many of you really believe that there's a 0% interest when you borrow money for 4 years? What business person, I see Danielle T going, that's crazy. Of course it's crazy. What business person is going to be out of money for 4 years and not charge interest? So what do you think the automobile dealership is doing? Right? They're saying 0% interest, but are they going to get their interest?
Yes.
Yes.
Yeah.
Address how?
They already included it in the price.
You got it. They're going to include it in the selling price. They're going to include it in the selling price. So what we need to figure out is how much of the selling price is implied interest. I know that in that non-interest bearing note that there is implied interest. In looking at exercise 10.9, that the $25,000 that I borrowed for 3 years, was a 3-year note, that I'm going to pay back $25,000, but I know that implied in the note is interest. Do you remember we dealt with this in accounts receivable in chapter 6? You all remember dealing with the non-interest notes in chapter 6? And we said the present value of everything you get is your sales revenue. Well, this is the exact same concept. Instead of us loaning the money, we're the ones actually borrowing the money. Okay. So my journal entry is, let me go ahead and share screen. And hopefully, I had to do it twice in the other first class too. Can y'all see it?
Yes.
Oh, yippee. So I've got that N is 3. The interest rate is 10%. They're not going to be making any monthly payments during the 3 years. So we're going to calculate the present value and the rate, 10%, the number of years, the payment, the future value, is B. I don't know if let me start over here. Okay, my rate is here in payment, future value. I thought I'd gotten it wrong. And type. So 18,782.87 is the present value of the note. This $6,000 is the difference between the face value of the note and the present value of the note. And you read on the note page that I gave you that the difference between the present value of the note and the face value of the note, that is the amount of implied interest in the note. Now, what am I going to do with that amount? Where does it go? What is that amount?
That's the discount.
Okay, good. That is the amount of discount, Alec. And what is within, as far as accounting goes, what account am I going to put that number into? And then what's going to happen to it over the life of the note?
You're going to put it in a discounted notes payable, and it either increases the carrying value, I think, of the note.
Mm-hmm.
Until it's up to the full value, and then that's
okay.
At the end.
And what makes it become the full value?
You pay interest expense on it. I don't know.
I hear somebody saying it is used for, I don't know if they're talking to me or if that's background noise for somebody. It's used for what?
I think it increases with interest expense, right?
Okay, right. So the carrying value is going to increase. The amount of the discount, this $6,217.13, is going to become interest expense over the life of the note. Okay. So our tractor, what am I going to debit the tractor for? What was the present value of everything that I paid or
18.
gave up?
23,000.
Edris, in addition to the 18, what else did I do? Did I pay anything down?
5,000.
Good. I paid 5,000 down. So my tractor is going to equal the present value of the note that I gave up plus the $5,000 that I paid. And then, of course, we know that we paid $5,000 in cash. Now, how much am I going to credit notes payable for? It's in the summary of the notes that I've given you. It's on the problem that you should have worked on page 527. Where do we credit?
The 25,000.
Good. You credit notes payable for the face value of the note. Credit notes payable for the face value of the note. So I'm going to credit notes payable for the 25,000. Now my journal entry isn't balancing. How much is it off by? What do I need? A debit or a credit?
Debit.
Good, a debit. And of how much?
The interest discount.
Good, the amount of the discount. Now, discount on notes payable. What kind of an account is discount on notes payable?
Is it a contra liability?
It is exactly a contra liability. Perfect. Obviously, it's linked to the notes payable account, discount on note payable. It's a debit balance. If you've got a debit balance account linked to a liability, then it is a contra liability account. Okay. So the discount on notes payable is a contra liability account. It's a contra liability account. It represents the amount of interest, it represents the amount, let me say, represents the amount that will become interest over the life of the note. Okay, so we've got notes payable that we put the face value of the note in. Can everybody see that? I'm sharing screen, but okay, so note payable, and then discount on notes payable is a contra liability account that represents the amount that will become interest over the life of the note. Now, notes payable, which is a credit account, discount on notes payable. Would it help if I quit sharing? Would it help if I quit sharing? Yeah, just, is that better?
Yes.
Sorry about that. Okay. So notes payable is the face value of the note. The discount on notes payable is a contra liability account that represents the amount that will become interest over the life of the note. Notes payable is a credit account. It's a liability account. Discount on notes payable is a debit because it's a contra liability account. And the difference between the two, notes payable minus the discounts on notes payable, equals what we call the carrying value of the note. So notes payable minus the discount equals the carrying value of the note. The carrying value is what's reported on the balance sheet, and it is also used to calculate interest expense. Okay, so notes payable minus the discount on notes payable equals the carrying value. The carrying value is what's reported on the balance sheet, and it is used to calculate interest expense. It is used to calculate interest expense. So now let's go into figuring out the rest of our journal entries. This was a 3-year note, so we need to calculate how much interest expense do I have for each of the years. Okay, Jake, you didn't feel like staying, and Anna, and that's okay.
I'm here.
Oh, I know you. I figured you were here. It's just not seeing y'all's faces. A lot of y'all's faces went away. So I'm going to go back into sharing my screen. Hopefully I get to just do it once. Can everybody see the screen?
Yes.
Yippee. All right. So we've got our journal entry where we've got the face value of the note, the amount that we capitalize for the tractor, which is equal to the present value of the note plus the $5,000 cash. And the discount is the difference between the face value and the present value, which is going to become interest over the life of the note. This is the amount of implied interest in that quote unquote non-interest bearing note. Now, this note, this tractor was purchased on January 1st, which, don't forget, your time's time. You got to pay attention to dates, but this one was January 1st. And on January 1st, when I purchased the note, my initial carrying value is the $18,782.87. So my interest, carrying value times rate times time. So my carrying value times my rate, and then times time. It was January 1st, so it was the whole year. So times 12 or times 1. And then I want to make sure, don't forget for good Excel techniques, that I want to anchor that the interest, the B4, because I want that cell to anchor, not copy relatively. I think Nelson was the one that gave us that anchoring term, wasn't it? Was Nelson that you? Nelson, did you leave me?
No, I'm here.
You're here. So weren't you the one that gave us that term that it anchors?
I don't think I said anchoring. I said absolute. I call it
Absolute. That's what it was. Yeah, you call it to make it absolute. Good. Now, what's going to be the carrying value? Oh, what's my journal entry? Debit interest expense and credit the discount on notes payable. You're reducing that discount because now part of it has become interest expense. If this was a regular interest-bearing note, what would I credit? This was just a regular interest-bearing note that you've known about since principals. What would we credit?
Interest payable.
Good. When we accrue interest, good. Interest, we credit interest payable. But we don't have interest payable. We're not going to be paying principal plus interest. We're just paying the principal and the implied interest. Now, when I credited discount on the notes payable, did that increase the carrying value or decrease the carrying value?
Increase.
Increased. Because discount on notes payable is a contra liability account. If I credit a contra liability account or a liability account, it increases. So the carrying value of my note is going to be increased by the amount of interest that we recognized. So now my new carrying value is 266116. What would be my interest for the second year? Go ahead and calculate it. What would be my interest for the second year?
2,066 and 12 cents.
Good. Everybody say it. Cool. 2066.12. And then for the third year, it would be 2272.73. Couple of questions. After I make the third journal entry, this one on December 31st of 2023, and I debited interest expense and credited discount on note for the amount of interest for the third year. Once I have posted this journal entry to the general ledger, what is going to be the balance of my discount on notes payable account? Come on, think. What did I? Zero, exactly. Nice job. Zero. Remember, I debited the discount on notes payable for the 621713, and then I'm allocating that into interest expense each of the 3 years. So is it a surprise that when I sum up the 3 interest expenses, that it sums to 621713? Should be no surprise at all. So the balance in my discount on notes payable is 0. Does it surprise you that the carrying value is 25,000?
No.
No, because notes payable is 25,000. The discount on notes payable is 0. So my carrying value is 25,000. I didn't make this happen. This was just the math. So when the company pays the note, they debit notes payable for 25,000 and credit cash for 25,000.
Wait, I got a question real quick. Can
Sure.
you go over again how you got the 1878 and the 2066?
Carrying value
Mm-hmm.
times my interest rate, which was 10%.
Okay. And then what did you do for the 2066? Was that the total of that?
That's
Times
the
the
8, this plus this.
Right. And then that's the 20,661 times 10%.
Correct.
Oh, okay. So the cycle continues for each year. Okay.
Yep.
Thank you.
You're welcome. So that is a non-interest bearing note, a non-interest bearing note. Any questions about the calculations and what kind of an account the discount note is? The amount that is capitalized is the present value of everything that we gave up. We gave up the 5,000 plus we gave a non-interest bearing note. So the present value of it was where we got to the 23, the 5,000 plus the 18. Okay, now let's take a look at the other ways to finance a long-term asset. So again, on the sheet that I had word processed for you, cash. We know that we're going to debit the long-term asset in credit cash. An interest-bearing note. You've been doing this since principles. You know, debit the long-term asset, credit notes, note payable. Then when you have to accrue interest, debit interest expense, credit interest payable, you know these journal entries. We just went over the non-interest bearing note. Exchanges. We're going to cover exchanges in chapter 11 when we're going through the 3 different ways that we can dispose of an asset, get rid of an asset. We can sell it, we can retire it, which is a fancy way of saying just throw it away, give it away, or we can exchange it. They talk about exchanges in chapter 10, and I want to make sure that you understand the difference between with commercial substance and without commercial substance. We'll talk about the accounting of it in chapter 11 when we're talking about the disposal of all of them. The last 2 is issue equity securities. Companies can acquire long-term assets by giving an ownership position in the company. I'll go to a startup company that you've got an entrepreneur, you've got all the brains behind what you want to build. You're the entrepreneur, you've got the, you know, product or service or that you want to do, but you just don't have any capital and you don't have an angel. Does anybody know what an angel is?
The beginning investor.
Good, a beginning investor. How are they different than VCs or venture capitalists?
Venture capitalism is through a firm.
Good, venture capitalists is to a firm, but how often are you going to get venture capitalists to be interested in a very brand new company? Not much. You usually have to get an angel investor. Sometimes they're family or friends or just somebody you know that's got, but anyway, an angel. Well, say somebody's got an angel, but instead of giving them cash, they're going to give asset. Say, I'm interested in your company, but you need a place to build your product. You need a warehouse. So the angel, this investor, says, I have a warehouse. I will give you the warehouse in exchange for an equity position. You know, if you watch Shark Tank, they get equity positions in companies. You know, right now, the United States, not by donating assets, but by giving cash, and we've done it before, is getting an equity position in companies by giving them money. Well, you can give long-term assets. So the angel gives them the warehouse that now is owned by the company, and the angel has got an equity common stock of the company. Now, at what amount would the company debit warehouse for and credit common stock for? At what amount? And I'll give you a hint. If you look at that summary sheet, I've summarized that chapter for you pretty well. Matthew, you were going to say something, Matt B?
No, I don't know if it was right.
It doesn't matter whether it's right or wrong. This is learning.
Fair value?
Oh, I had two Matt B's. I'm sorry. This is Matt B-E-N. Good. At the fair value of what? The asset or the equity?
Asset?
Almost. What's the other one?
Oh, equity.
Equity. So you will debit the asset and credit common stock for the fair value of the equity. Unless, and this is, Matt, where you get into having the correct answer, unless the fair value of the equity is non-determinable. Now, here you are, an entrepreneur, brand new business. Do you think that the fair value of the equity is determinable? You haven't done anything.
Not at this point, no.
Not at this point. You're exactly, might be Matt BUS, that it's not determinable. So if the fair value of the equity is not determinable, then what do we use?
Book value?
Good. Not book value, because we don't have a book value. The fair value of the asset. So first you use the fair value of the equity. If the fair value of the equity is not determinable, then use the fair value of the asset.
So you're saying like all assets that like go into the company, like that's how they get the value at the beginning?
The value of what?
Of like the company, because you're saying you can't go by equity.
Right. Well, really,
point.
is there, it's very difficult to determine the fair value of the equity of a company that hasn't done anything, if not impossible. So they would use the fair value of the asset itself. Okay.
Okay. What if it's like multiple assets though? Or are you saying, is it usually just like one asset?
Well, no. What if it's multiple assets? You answer your own question. What would you use?
Like the sum of all of them?
Okay, and how would you calculate it for each one? What do we do when we acquire multiple assets with one price? We did this on Thursday. Pardon me?
I don't know. Do you break each one down or?
You remember the lump sum purchases that we did based on the standalone price?
Oh, okay. So you just roll that into a lump sum then?
Right. See, that's one of the things about siloed learning, why, we need to, integrate. We call it interleaving in pedagogy. But, why we need to interleave. Yeah, just use that concept of lump sum distribution.
Mm-hmm.
Okay, makes sense? It's like, oh, yeah, I forgot about that, right? We use the tools in the whole company, not just in like we learned silo learning. So what happens if we have donated assets? So somebody donated, usually a governmental entity, because as you read in the chapter, who's going to donate an asset? You know, yeah, I may have somebody that donates an asset for me. Maybe my dad, you know, says, here, donate, I'll donate the warehouse. I'll be your angel, but I'm not going to ask for an equity position. What would we do? We would debit the asset at what amount, and what would we credit?
Credit revenue.
Okay, great. We credit revenue. Donated assets creates revenue. Donated assets creates revenue. And what would we debit the asset for and credit revenue for? At what amount?
Fair value.
Good, the fair value of the asset.
Why would receiving a donation increase your revenue?
What else would you want it to give me an example of what else you would want to credit? Increase.
Okay, I guess like yeah, because it's like the account that's there, but like.
Well, it's not equity because they're not asking for an equity position.
Okay.
Now, would this be classified as my regular operating revenue, or would it be included in other revenue?
Other.
Right, it would be part of other revenue. It's not revenue from my operations, but it is just other revenue, because they're donating the asset, but they're not asking for an equity position. Okay, so we see this with governmental entities. You know, companies, country, I'll spit it out in a minute, counties, states, they want to, you know, attract businesses to come to their place of business. They want the jobs in their place of business. They want all of the attributes that a company can bring to a geographical location, you know, a county or a state. You know, New York City, they almost had Amazon there until politics got involved and Amazon said, we're gone, we're not going to be here. There were a lot of counties or states that were trying to attract Amazon and put these attractive packages together to attract them. And one of the things could be, what if the county has some land that they're not using? You know, they could donate the land and say, here's some land, build the warehouse here, build the corporate headquarters here, donate to the land, you know. So that's often where you see donated assets, or with governmental entities that are trying to attract businesses. And that is what you read in the chapter with respect to donated assets. But it does create revenue because they're not asking for an equity position. Okay, so it's just other revenue, not revenue from operations, as Edris pointed out, but just other revenue that they had. They're given this asset, so it is revenue. Those are the ways that we can finance long-term assets. Now let's move on to capitalized interest. And before we get into capitalized interest, I want you to understand the concept behind capitalized interest. So the first question that I'm going to ask is, why is capitalized interest that we include in the cost of an asset? This is self-constructed assets. So we're going to build our own asset. Why is capitalized cost? Why is interest considered part of the capitalized cost? What is the concept behind capitalized interest? Why?
I actually had a question about this on like the ASC. Is it just to evaluate our asset, to like know what we're investing in?
Well,
like to know the value of investment?
it is a cost that we're investing, but why does it just not go into interest expense? Why do we capitalize it?
Because it's specifically incurred in order to develop the asset and get it ready for use. So it's kind of like equivalent to the concept of like getting ready.
Okay, again, that's what Edris was saying, was that, yeah, we're incurring this interest to acquire or build this asset. But why did why did the FASB say capitalize a certain portion of your interest instead of expensing it?
I read something about like it may like throw off the earnings in future periods. Oh, that's right.
Did you read anything about avoidable interest? Did that concept come up in your
Oh, yeah. The idea is that they wouldn't have incurred this interest if they weren't engaged in this project.
Exactly. Look at page, look on page 536. Look at the very last section that's called average accumulated expenditures, and read that first paragraph. There are 4 italicized words, and you know when you see italicized words, it's important. Read that paragraph. So what did you learn?
It's based on the average expenditure.
Right, that's how you calculate it. But what is the concept? Like, can I build a building and have no capitalized interest?
Yeah, if you didn't have to.
Yes. So why? And so that's what Edris was talking about. It's part of the cost. But can I build a building and have no capitalized interest? Build my own warehouse? Yes. Why, in some cases, do I have capitalized interest? And it is that whole concept where you read could have been avoided. Could have been avoided. We call that avoidable interest. Avoidable interest. And the concept behind it doesn't have anything to do with the fair value of the asset that you're building. It doesn't have anything to do with that. It has to do with, number one, look at the decision tree that I've given you. So now let's look at the decision tree to understand the concept of avoidable interest. Now, in the sheet that I typed up for you, the chapter 10 note sheet, and where I have self-constructed interest, and on this it says how to calculate capitalized interest, I even highlighted avoidable interest. Okay, so it's on the sheet, it's in the book. So the whole concept of avoidable interest. When you look at the decision tree, and we're going to go through the whole decision tree in just a minute, but before we do, notice that the very first question is there specific debt? Yes or no? And specific debt has to do with did the company go out and borrow money specifically to build this asset? Specifically to build this asset. So one, companies can go out and build and borrow money to specifically construct the asset. They bought land, they want to build their warehouse, so now they're constructing the warehouse. Do you remember in chapter 6, revenue recognition, that we were the contractor and we had the billings to our customer? Well, these are the billings that the customer is paying. They're going to be paying amounts to the contractor. Well, they could have gone out, the company could have gone out and borrowed money specifically to finance the construction of this warehouse. In other words, they have specific debt. If you look at the other side of I'm looking at the decision tree that I have given you. So it says, is there specific debt? If the answer is yes, we got a whole bunch of calculations to do. If the answer is no, that they didn't borrow specific debt, we could still have avoidable interest or capitalized interest if they had other outstanding debt. So get these two terms separated in your head. Specific debt is where I went out and borrowed money specifically for the construction project. Other outstanding debt is just LTD, long-term debt that the company has that they've been having for a while and are just paying off, or they just got last year, but is other outstanding debt that's unrelated to building the asset. So why would I capitalize interest that is unrelated to building the asset? The whole concept is, if I were not building this asset, number one, if I have specific debt, I wouldn't have the specific debt if I wasn't building this asset, and thus would not have the interest. The other thing is that if I were not building this asset, then I could have paid off the debt, my other outstanding debt. I could have used the funds, instead of building a warehouse, I could have used the funds to pay on my debt and avoided interest. So the whole concept is about avoiding interest, and even avoiding interest that is not specifically related to the asset I'm building. We can still have capitalized interest when I don't have a specific debt. Again, specific debt is debt that I've gone out and borrowed specifically to build the asset. So you see, Edris, where you talked about like it doesn't have anything to do with the fair value of the asset I'm building. It doesn't even have anything to do with interest that I am directly incurring on the asset with specific debt. It can have interest that I have avoided because I could have paid off other debt. So it's really, I can't define it other than avoidable interest. So the concept is capitalized based on these calculations of the amount of interest that could have been avoided either on the specific debt and or the specific debt and other debt, or just on the other debt. Okay? So does everyone understand the concept of avoidable interest? Okay, so because of this concept of avoidable interest, we get into some heavy duty calculations. And before we get into the calculations, I want you understanding the terminology that is used and the decision tree. So before we get into any numbers, let's go through the decision tree. Everybody have this? Okay. Now this decision tree is on an exam in class is not available, but online you got an available decision tree. But understand it, because if you don't understand it, then it's gonna, again, it'll take you too much time to learn it and be able to finish the exam. Okay, so let's start. Is there specific debt? Let's go through the side of no. And again, we're not going to get into numbers here. I want you understanding. So is there specific debt? Meaning, did they go out and borrow money specifically to build this asset? If the answer is no, then do they have other outstanding debt? Now, I don't know of too many companies that have no long-term debt. First of all, they aren't using leveraging very well, which is an upper level business concept, but they're not using leveraging very well if they don't. So most companies do have long-term debt. So do they have other outstanding debt? If the answer is yes, then what do I have to do? I've got to calculate, the WA stands for weighted average. I need to calculate the weighted average interest rate on the other outstanding debt, and then multiply it by the WAAE. What does the WAAE stand for? You read this during the chapter. What do we have to calculate? What's one of the things you have to calculate? And it's on page 539, all the things that what you calculated.
That's weighted average expenditures.
Right, rated average accumulated expenses. Expenditures is what they use. So good, Alec. Was that Alec?
Yeah.
Or Brett? Alec. So the weighted average accumulated expenditures. Weighted average accumulated expenditures. So in order to calculate the capitalized interest, when there's no other outstanding debt, no specific debt, and there is other outstanding debt, sorry, I said that wrong. If there's no specific interest, but there is other outstanding debt, then I have to, one, calculate the weighted average interest rate of the other outstanding debt. And number two, I need to calculate the weighted average in accumulated expenditures. Multiply the two, and that is the amount of, and times time, that's the amount of my capitalized interest. Okay. We're going to practice this in just a few minutes. Now, let's go back up to the start. Is there specific debt? Yes. Meaning the company went out and borrowed money specifically to finance the building of this asset. So is there specific debt? The first question that I'm going to look at is the weighted average accumulated expenditure greater than the specific debt? Now, I'm just going to use general numbers here. I told you that we weren't calculating numbers, but I want to just give you an example. So let's go through the one where it's no. The weighted average accumulated expenditure is not greater than the specific debt. In other words, my WAAE is less than the specific debt. Then I multiply the weighted average accumulated expenditure. We need to learn how to calculate the WAAE. We multiply the weighted average accumulated expenditure by the interest rate of the specific debt, and then times time. Okay. Now let's get into the granddaddy of them all. Is the weighted average accumulated expenditure greater than the specific debt? Yes. So let's say that my weighted average expenditure is $2 million. And my specific debt is $1.8 million. So obviously my weighted average expenditure exceeds my specific debt. My weighted average expenditure is $2 million. My specific debt is $1.8 million. Okay. I am going to, let's see. I'm typing a polling question right now. All right, sorry, all right, there it comes. No, it did the LIFO one, didn't it? Well, I just typed a new one. Oh, well. My question was, I don't know why it's not letting me do a polling question that all right, so my question is, and I want you to chat it to me. My question is, what was the amount of the specific debt that I just mentioned? What is the amount of the specific debt that I just mentioned in my sample? So if you can send it to me as a chat.
Do we just X out this LIFO concept question?
Oh yeah, sorry, I thought I deleted it. All right, so just send it to me privately. What was the amount of the specific debt that I just mentioned? In the example that I was doing. All right, I'm going to give you about 3 more minutes. Okay.
Did you give us an interest rate?
No, I didn't give you an interest rate. I just gave you an amount.
Is it okay if we don't know?
Yeah.
Yeah, can you repeat it again? Like I'm pretty confused with the question, like the meaning
Okay,
of it.
in the example that I just did, I said that the amount of weighted average accumulated expenditures was a certain amount, and I said the amount of the specific debt was a certain amount. And what I'm looking for is what I said as the specific debt. All right, I'm giving you 2 more minutes.
Yeah, I think I was like writing down some of the conceptual stuff still.
That's okay. Just send me something.
Okay.
Okay, I am stopping it now. And just what I thought, I don't have a lot of you paying attention. And we are, and some of you are here, but not here.
I honestly was trying to follow, but I just was writing down some stuff. I was like looking through that tree and just trying to make sense of it conceptually still. So I apologize. Like I wasn't
okay. It's just I have a feeling that I have a number of students that are like logged in, don't have their face showing, and aren't really here.
Yeah.
And
I'm here. Was my answer close? I was more paying attention. I was trying to read the note tree too, but
I understand. I have only 2 people that got it correct, and then I have 2 people that got the other number that I mentioned, and I have a whole lot of people that went to the bathroom all of a sudden. And I'm not saying that you didn't. It's just amazing how many at the same time went to the bathroom.
Was
anyway,
there supposed to be math being done?
Pardon me?
Like, you didn't give it, like, because according to the tree, like, you need.
Okay, let's just continue on. So when I've got a lot of people without their faces on, I understand it's in the morning and all that, but it just, and we're talking about a very difficult thing, and then I'll have a bunch of questions about something that was clearly discussed in class, and it gets frustrating. So, all right, so let's go back over. So we're starting with, is there specific debt? And I said, yes, there was specific debt. And I said, is the weighted average accumulated expenditure greater than the specific debt? And I said, yes. I said, let's suppose that the weighted average expenditure is $2 million and the specific debt is $1.8 million. So the answer was 1.8 million.
I put 2 million. So
that's okay. If you put 1 or 2, at least you were listening. All right, so the weighted average accumulated expenditure was $2 million, and my specific debt was $1.8 million. Right. So the first thing that we're going to do is we're going to multiply the amount of the specific debt by its interest rate, the 1.8 million. Times whatever its interest rate, because again, I'm not getting into calculations here. That's why there's no interest rates, but I want you understanding the tree and how to read the tree with all the, WAAE and if this and that. So multiply the amount of the specific debt by its interest rate. So we would do the 1.8 million times its interest rate times time. Then step 2, subtract the amount of the weighted average accumulated expenditure, subtract the specific debt from the weighted average accumulated expenditure. In other words, what you need is how much does the weighted average accumulated expenditure exceed the specific debt? And in this case, it would be how much?
Like 2 million?
200,000, right? It was 2 million and 1.8 million. So 1.8 million times the weighted average interest rate, the interest rate of the specific debt, sorry. Then the excess of the weighted average accumulated expenditure, the 200,000, would be multiplied by the weighted average interest rate of the other debt, not including the specific debt. The weighted average interest rate of the other debt. That same weighted average that you calculated if there was no outstanding debt. Okay? So now I've got my the specific debt multiplied by the interest rate of the specific debt. And then I have the amount that the weighted average accumulated expenditure exceeds the specific debt, and I multiplied it by the weighted average interest rate. Then I added step 1 and step 3 together. No, step 1 and step 4, you know, I multiplied the 200,000 by the weighted average interest rate. And then I add step 1 and step 4 together, and then I'm gonna multiply by time. Okay? So what you see is, depending on whether the company has specific debt or not, is going to change our calculations. Change our calculations, okay? So now let's apply the concept that we learned in the decision tree. Let's take a look at exercise 10. We'll do exercise 1025 first. And exercise 1025 is on page 557. 557. Yeah. Okay, on page 557. I'm going to go into Excel and share screen with you so that we can calculate. Now in exercise 10.5 on page 557, we're going to take an easier one first. Do we have specific debt?
Yes.
We do?
On 1025?
Yeah. Do we have specific debt?
Oh, no.
No. So we don't have specific debt because it says no new loans were acquired. So we have 0 specific debt, but do we have other outstanding debt?
Yes.
So we're going to have to calculate weighted average accumulated expenditures, plus we're going to have to calculate the weighted average interest rate. Now, on the decision tree, I have given you a hint, and we're going to utilize that hint. This hint has saved, it's not in the book, this little hint thing. So I'm going to go into Excel, and we're going to utilize the hints. Let me find my, well, I did have it saved, I promise, somewhere. Okay, not coming up. Let me pull up the Excel. Where did that thing go? Let me pull up Excel. Let me share a screen. And y'all can be working it. Let me see if it's in another. Oh, all right. One of the first things that I want you to do is calculate what is the capitalization period for this project. Now, the capitalization period, as you read in the book, is the day that we start the project and then the day that it ends when the project is substantially complete for its intended use. And this project began on what date?
8 months, July.
July 1st, and I will enlarge it, of 2021. And when did it end?
March 31st.
Good, March 31st of 2022. The first thing that I do when I work these problems in order to keep me out of trouble, and this is the hint that part of the hint that I've given you, is calculate the how many months is the capitalization period in any year. This particular project was it started in July of one year and it ended in March of the other year. So how many months in 2021 is my capitalization period?
9.
9. Anybody else have a different?
2021, it's 6 months.
It's 6 months, right? From July 1st of 2020, right? So we're looking just for the year, because I need to calculate. I see what you're saying. You said 9 months was the whole project.
Yeah, I thought it went to March, like the whole thing.
Well, it does, but what we have to do is we have to calculate the capitalized period for each year, because we need to calculate capitalized interest each year.
Mm-hmm.
So in the first year, how many months?
6
months.
6 months, right? Yeah. And then how many months were in the 2022?
3 months.
3 months. I'm going to show you why it is so important to stay out of trouble by putting this notation at the very top of your problem. Now, we don't have any specific debt, so we need to calculate the weighted average accumulated expenditure, and then we're going to have to calculate the weighted average interest rate of our other debt. So on my weighted average accumulated expenditure, what were my expenditures during 2021 and what date? So on July 1st, 2021, how much did I spend?
400,000.
400,000. And then on September 30th of 2021, I spent 600,000. And then on November 30th of 2021, I spent 600,000 again. Now I need to calculate my weighted average accumulated expenditure. My weighted average accumulated expenditure. I know that I spent $1.6 million in 2021, but that's not my weighted average number. When you are calculating the weighted average expenditure, here's the help of why I make sure to put the number of months in my capitalization period, is when you are calculating your weighted average accumulated expenditure, look at the hint on your decision tree. I put the number of months of the capitalization period in a year so the number of months was 6 in 2021 and 3 in 2022, is the denominator for calculating your WAAE. They don't tell you that in the book. You just see it on page 529, I think it is, on the calculations. They don't tell you that. It's just one of these helpful hints from Heloise. Call me Heloise. So the number of months of the capitalization period is the denominator for calculating your weighted average accumulated expenditures. Now, how many months, this was my expenditures during the year. What was the number of months that it was outstanding during the year, during the capitalization period? So July 1st, good, was outstanding for 6 months. How much was the $600,000 I spent on September 30th?
3 months.
3, good. And November 30th?
2 months.
1 month.
Or 1 month, sorry.
1 month. Good, it was 1 month. What is my denominator going to be? So this is the numerator. What is my denominator going to be for each one of these?
6.
6. Okay, remember, that is that helpful hint. Don't forget it, that the denominator for calculating your weighted average accumulated expenditures is the number of months in the capitalization period. This is my number of months that it was outstanding during the capitalization period. During the year, okay? And I will wrap that text. So I'm going to say equal the amount that I spent times, what is my numerator?
6.
6. What is my denominator?
6.
Right, because it's the number of months in my period. Notice that I'm going to now anchor that 6 in when I'm doing it in Excel. And obviously 4,000 times 6 over 6 is 400,000. What would it be for the September 30th?
300,000.
300,000. My numerator is the number of months that it was outstanding. The denominator is 6. Now calculate it for November.
1.
Right, because it was 1 month. The denominator is 6. So my weighted average accumulated expenditure for 2021 is 800,000. Now I need to multiply it. Use your decision tree. Is there specific debt? No. Is there other outstanding debt? Yes. Multiply the weighted average accumulated expenditure by the weighted average interest rate of the other debt. So my weighted average interest rate of the other outstanding debt, in other words, do not include the specific debt. This particular one didn't have specific debt, but others are going to have to. So what is the weighted average interest rate of the other outstanding debt? It does not include the specific debt. So what was the other interest that they had? They had a debt they had. They had a $2 million debt at what percent?
8%.
8%. They had 8 million at 4%. So let's calculate the interest. This interest would have been outstanding for the whole year. So principal times rate, outstanding for the whole year, times time, and then add it down. I just copied it down because the 8 million times the 4% is 320,000. I didn't think I'd done that right. So I had $10 million worth of debt, and my annual interest is 480,000. How do I calculate the weighted average?
You divide them.
Divide the interest by the principal. This is, and we're going to round to 3 different decimal places. You're going to get interest rates that are not, you know, so round like this one is. So the weighted average interest rate of my other outstanding debt is 4.8%. So what is my capitalized interest for 2021? So I'm going to do the weighted average interest rate times the weighted average accumulated expenditures times my weighted average interest rate times time. Now, I emphasized it twice. So read both the hints. One is the number of months of the capitalization period in a year is the denominator for weighted average accumulated expenditures. So we use the 6 for 2021, and the numerator for calculating time. So it's the denominator for weighted average accumulated expenditures and the numerator for calculating time. What is the denominator for calculating time?
12.
12, because interest is an annual rate and there are 12 months in a year. So I'm going to multiply it. I've already done the weighted average accumulated expenditure times my interest rate. Now I'm going to multiply it by time. What was my capitalized period?
6.
6.
Professor Bostic,
Yeah.
where did you get that 4.8?
The 4.8 is the total interest divided by the total principal.
Okay, thank you.
You're welcome. Yeah, so, you know, we calculated the interest for each note. So the total interest for a year for a company, for this company, is 480,000 with a total principal of 10 million. You will be calculating weighted average interest rates throughout your business career. So this skill is, keep it with you. So 4.8% was my weighted average interest rate. My capitalized period was 6 months. So my weighted average interest rate, the 4.8%, times my weighted average accumulated expenditures times 6/12. Where did the 6/12 come from? Where did the 6 come from?
Month.
Because it's
Capitalization period.
Good. It's the capitalization period during the year. That's 6 months. The denominator is 12 because there are 12 months in a year. So the amount of interest that would be capitalized during 2021 is $19,200. So 19,200 is my capitalized interest for 2021. In other words, this company, when they did the journal entry, say that they paid it all at December 31st. God, I can't even spell expense right now. What did they build? A warehouse. And let's say that they paid cash for it. If they accrued it, they would credit interest payable. So we know that they paid $480,000 in cash. What would they debit the warehouse for? The warehouse is the asset that they're building. What is the capitalized interest? What does capitalized mean? Don't forget what capitalized means. So capitalized means becomes part of the asset. So how much did the warehouse increase for the capitalized interest for 2021?
Why are they paying $480,000?
Well, they're paying $480,000 because they had these two notes with these interest rates. And so they have to pay the bank every year or accumulate every year. So this would be the yearly interest, right? Yeah. On the other outstanding debt. Because this debt was just outstanding. They didn't just acquire this debt.
Yeah.
So it wouldn't have been outstanding for the whole year?
Yeah.
So I'm trying to figure out when they paid the $480,000, what is the journal entry? So how much of it did we calculate was capitalized?
19,200.
Good, 19,200. So how much of it would be expensed?
The difference in capitalization and cash.
Oh, that makes sense.
Okay, do what, Matt?
Wouldn't it be the difference, like how you got the 460? Wouldn't that be the interest expense, the difference between the capitalized and cash?
Right. If I'm paying $480,000 in interest and I'm capitalizing 1920, then the difference has to be interest expense.
So when you say warehouse, that's the interest incurred on the warehouse.
Correct. Isn't that what they're building?
Yeah, no, I just when you type warehouse in my head, it's just like a building, but
you can debit building or warehouse or whatever you want to call this asset. I see what you're saying. So yeah, if you want to call it building, you can call it building, but it's the asset. Because remember, capitalized, when we capitalize something, that means it goes into the asset. We learned that in the beginning of the semester.
Could it be possible to say like warehouse interest or like
Nope. It's the asset itself. Just like when you paid like this 1.6 million on July 1st, they debited warehouse for our building for 400,000 and credited cash. On September 30th, they debited warehouse and credited cash. On November 30th, they debited warehouse and credited cash. Okay. Now, let's calculate, this was weighted average interest for 2021. Let's calculate it for 2022.
So conceptually, this is like when they're basing these expenditures on like a liability. Like if they had paid all those things, well,
it's avoidable interest.
Could you scroll up to the top just?
Oh, sure. So if they would not have spent this 400,000 on July 1st, the 600,000 on September 30th, and the 600,000 on November 30th, they would, and they used that money on these dates to pay on these notes, they would have avoided 19,200 of interest.
So even though they paid cash for it, it's just that's cash they would have used to pay the interest, basically.
Although they paid cash for what?
For the expenditures. You were saying they would debit warehouse and credit cash, right?
Oh, right, for these three, yes.
Yeah.
So if they had used this 1.6 million to pay off the principal on their note, remember the whole concept of avoidable interest is they would have used the money to pay off debt instead of building a warehouse. So if they would have used this 1.6 million, 400,000 on July 1st, 600 on September 30th, 600 on November 30th, they would have avoided, because they would have paid on these notes, they would have avoided 19,200 of interest. So that's why it's capitalized, because it's that avoidable interest.
Yeah.
Is the weighted average always a annual percentage, or
yes?
Like what if that outstanding debt was taken on like in the middle of the year? How do you calculate the percentage?
Yes, you would have. If this was acquired in the middle of the year, then this 160 would have been times time.
Okay, thank you.
Okay, but you would have to discern it between, it's not specific debt, it's just other debt for something else. If it was specific debt, remember, we're going to handle it differently.
Okay.
I'm not going to have where this other interest was purchased during the middle of the year. I think you got enough calculations without that. Okay?
So for 2022,
yes. Now let's get into 2022. Go ahead, Melissa.
Is our weighted average interest rate going to be the same as for 2021?
Yes, it is.
Okay.
Yep. Yes, it is. Good. So now my weighted average accumulated expenditures were my expenditures God, what is expenditure? If I type it quick, then so my expenditures, I still misspelled it, from 2021 are being carried forward to 2022. They were capitalized. So the amount of expenditures that I spent in 2021 is 1.6 million. That's the amount that was capitalized. My expended, oh, here it is. Oh my gosh. So that's better spelling. So my expenditures for 2021 was 1.6 million. Well, here, let me put my capitalized interest, I'll call it. So my capitalized interest that was in 2021, that was debited to warehouse, is the 19,200. So in the second year, you need to bring forward what you spent in the year before. And in the third year, you need to remember to bring forward the expenditures from the prior 2 years. They're being capitalized. So I bring forward the 1.6 million, not the weighted average accumulated expenditures, the amount that I actually expended in 2021, the 1.6, plus my capitalized interest in 2021. And then on January 30th of 2022, I spent 540,000. because that was a given. Now, what was my construction period during 2022? It ended March 31st, so how many months did I have in 2022?
3 months.
3 months. Now that 3 months, how am I going to use it in calculating my weighted average accumulated expenditure for 2022?
As the denominator.
Very good. It's going to be the denominator. Now, how many months was my expenditures from 2021 outstanding during the construction period in 2022?
0.
Well,
But it was standing in 2022.
right. So how much was it outstanding during 2022? I
3
incurred it in 2021. So how long was it outstanding in 2022?
3 months.
3. Good. And the capitalized interest?
3 months as well.
3. Now, what about the 540,000 on January 30th? Right. So it would be 2. Between January, how long was it outstanding until March 31st? The end of my capitalization period. I put the warehouse, I began using it March 31st. It was substantially complete March 31st. So now let's get into our calculations. We know that this is going to be my numerator. What is going to be my denominator?
It'd be 3.
Exactly. It is always 3, the number of your months. That's the reason that I put this up here, to remind me it is my denominator for calculating my weighted average accumulated expenditures. So equal the amount times, what's my numerator? 3. And then divided by my number of months in the capitalization period. Of course, I'm going to want to anchor the 3 because the denominator is going to be the same. Calculate what is my weighted average accumulator expenditures for 2022 for my January 30th.
360,000.
All right, how did you get it?
2/3 times 540,000.
Exactly, 500,000 by 2/3. 2, because that's how long it was outstanding during the capitalization period, February and March. 3 is my denominator because my denominator is always my capitalization period. For the year, it was 6 in 2021 and 3 in 2022. So 360,000. And my weighted average accumulated expenditure for 2022 is 1,979,200. Now in this problem, did we have specific debt? No. So what am I going to multiply the weighted average? This is my weighted average accumulated expenditure for 2022. So what am I going to, what is going to be the amount of my capitalized interest for 2022? What am I going to do?
Multiply it by the 4.8%.
Good, you said multiply it. What is it?
The weighted average accumulated expenditures for 2022.
Good. I don't want you confusing it with the total amount that's been capitalized to date. It's the weighted average accumulated expenditure, good, times my interest rate. What else do I need to do to it?
Don't you times it by 3/12?
Beautiful. Nice job. Was that Edris?
That was Matt.
That was Matt. Thank you, Matt. Sorry, I wasn't looking at my gallery view. So times, remember, the number of months of your capitalization period becomes your numerator for calculating time. So times 3/12. And my capitalized interest for 2022 is 23,750.40.
I have a question.
Sure.
So if they expended like the expenditure instead of on January 30th, it was on January 1st, 2022, would the number of months outstanding be 3?
If this was on January 1st,
Yeah.
yeah, then this would be 3.
Okay.
Yeah.
That's it.
So of course, I would calculate, I would credit cash for the total amount of interest. This is the only debt they have. I would debit the warehouse for the amount of capitalized interest and interest expense for 2022 would be $456,249.60. Now,
So, sorry, you have to pay.
Pardon me? I didn't.
Oh, I was saying, so you have to pay interest on the capitalized interest from the previous year.
I am paying interest on the liability that I had outstanding. And at December 31st, or at March 31st, 2022, I still had these 2 debts outstanding at this interest rate. Make sense?
Mm-hmm. And then we're figuring out how much of that is for the project.
Right. So to figure out how much of it was for the project is all based on calculating your WAAE. Which, oh, I see, because yes, I've got to include prior year's capitalized interest because, again, there's that assumption of avoidable interest. And I would not have paid that $19,200 if I weren't building this warehouse.
Yeah.
Okay?
Okay.
Now, in the 8 o'clock class, we were able to just get started on exercise. Well, we barely did now that I think about it. We got about this far also. Between now and Thursday, because I'm going to be posting a problem that I've written that of course has the whole gamut. I want you working exercise 1024 between now and Thursday. Okay. I don't know, was this the class that we discussed moving the AS2 till Friday at 7? Is that what we talked about?
Yes.
Yeah.
Okay, I couldn't remember if that was the 8 o'clock class or the 10 o'clock class. So I will go ahead and upload that. I will also upload the solution to 1024 is uploaded, but I don't think it's just labeled differently than I did. But I will go ahead and upload my solution, of course, in PDF because of the problem with using my formulas for an exam. But I will go ahead and upload this. I'm going to upload the problem that we're going to work in class on Thursday, but I really need you to work exercise 1024 so that you're ready for the problem that I'm going to work on Thursday. And then we will start chapter 11. I know we've gotten out, since we started online, we've gotten out of the habit of doing a quiz when we first start a chapter, but because of time, it's slower in class, which is fine, online, which is fine. I am not going to have a quiz on chapter 11 because we're starting it on Thursday. I will be posting an announcement about when we will have a quiz because I want y'all having quizzes for practice. And so I will put an announcement up. So just be looking out for announcements, and please, please, please practice 1024, exercise 1024. It has both specific debt and other outstanding debt. Okay?
Okay.
All righty. Peace out. And I didn't mean to fuss at y'all. I just got the feeling that I was losing y'all, and I need to pull y'all back in because we're at the end of the semester going, oh, no individual person needs to apologize. I just need to keep y'all all focused. All righty? See y'all.
I have a question.
Yes.
Have you received the email from me? Like,
how do you receive email from me?
No, I sent you the email, like, to ask you a question. So I don't know if
you a chat? I'm sorry, I just didn't see the chat.
No, not the chat. Your specific.
Oh, I did not. With everything going on with my daughter-in-law yesterday, with her having her liver failing and them having to put her in the hospital and for them having to induce labor. I'm sorry, I was checked out yesterday. I did not check email yesterday at all. So I've got some catching up to do now that my granddaughter is born and my sister-in-law, daughter-in-law is okay, and they don't think the liver damage is permanent. So
glad your granddaughter is okay too.
Yes, my granddaughter is okay.
Sorry to hear
she was
that.
born a month early, but she weighs 6 pounds, which is great. So thank y'all. I appreciate that. So it was quite an interesting night because she was in labor all night. So thank y'all for that. I really appreciate it. Sadie is her name.
Yeah.
All righty. So I'll get everything uploaded for y'all so we can keep rolling and get chapter 11 done efficiently. Okay.
Sounds good. Thank you.
You're quite welcome. And thank you. You're welcome. Bye-bye.